Welcome to the Compounders Podcast. On this show, we explore the topic of compounding from various angles, including through interviews with public and private company executives, investors who focus on compounders, and newer investment firms that are building a business they hope will become more valuable over time.
All opinions expressed by the host and the podcast guests are solely their own opinions and do not reflect the opinion of Devonshire Partners, LLC, or any affiliates. This podcast is for informational purposes only. It is not investment advice and should not be relied upon for any investment decisions. We are not recommending the purchase or sale of any securities. The hosts and guests may be beneficial owners of the securities discussed. You should not assume that the securities discussed are or will be profitable.
My guest on the show today is Joe Magyer, the founder and managing partner at Seaplane Ventures. Joe spent the first part of his career in public equities and in 2022 founded Seaplane to focus on early stage investing. We have not had many VCs on the podcast before, and I was excited to speak with Joe about his journey from public markets to venture investing, what the name Seaplane means to him, where the firm plays in the VC ecosystem, why he has decided to concentrate his investments, and how the skill set he developed after a long time in public markets helps him with his new venture today. And without any further ado, here's my conversation with Joe Magyer of Seaplane Ventures. Joe, like me, you've made your way from the public markets to focus more on the private markets. I'm intrigued to hear about the journey that got you to the point where you were ready to start Seaplane Ventures.
Sure. Well, the reason I'll start at the end, which is that I just found private, particularly early stage venture, more fun, more interesting, and the returns potential is just much higher than public. So that's kind of the conclusion for how I ended up launching Seaplane. But to go back in time, I got into investing when I was a kid. My grandfather managed his own money, and that rubbed off on me. And I would sit around as a kid talking to him about businesses and stocks and the kinds of companies that he liked to invest in. And it just sparked this curiosity, interest, passion, leading into obsession with investing over the rest of my life. I started with public markets because that's kind of where everyone tends to start, unless you happen to be born on Sand Hill Road or something like that. But that's where the early part of my career was. And I was focused on particularly US mid large, which you can do very well with. But I remember being at the Value Investing Congress 15-ish years ago, and there was a presenter who came up from India, and he gave a great talk. And he was like, I'm going to pitch a couple of stocks today that I think are just as high quality as a lot of names you've seen here today. The difference is they're in a part of the world that nobody pays attention to. And so they sell at half the price. And that really got my attention. And I looked around the room and I saw a lot of guys who looked just like me, who had very similar philosophies, dressed the same way, looking for the same stuff. And I thought, I probably need to be looking other than just the same pool of stocks that everybody else in this room is competing over if I'm going to generate massive outperformance. About a year later, I had a chance to go to Australia to help set up an investment team down under and jumped at that. It seemed like a great opportunity to do something entrepreneurial, but also focus in particular on small cap growth in Australia, which is not a part of global markets that get much attention, but is very interesting because the Australian Stock Exchange, in addition to being really literally out of the way and not getting much attention from overseas investors, the smaller opportunities there tend to be ones that are nano scale by American standards. And there are a lot of companies, particularly in tech, that list in Australia that are venture scale, sometimes as small as like Series A scale. But the venture scene in Australia is a 50th the size way as America. So essentially, we were doing public venture. And over the span of 9 years that I ended up being there by the time I left, we'd started a subsidiary called Lake House Capital that I ran for years. And we had almost $1 billion in assets, Aussie, by the time I left. And it was mostly doing what amounts like public venture in Australia. And I had a lot of fun with that, fair bit of success. But for a variety of reasons, the family and I wanted to come back to America. And I also learned along the way with Lake House, that while I loved the team, the mandates, I had tremendous creative control with what I was doing. I didn't enjoy running what felt like a big shop to me, and I wanted to get back to being a true boutique and just being at the coal face. So when I came back to America, I wanted to just focus on early stage. It was what interested me most and was the earliest, and we can get more into it, but the earliest spot where I thought I could put my skills to work, but also allow me to focus entirely on, to me, what are just the fun parts and not spend time having meetings about meetings. And sure, started up Seaplane after we got back 3 years ago.
And given that most of the firm names with Stone, Rock, and Creek in them were already taken, my guess is that you had to be creative in naming your firm. What does the image of a seaplane represent to you?
Freedom, adventure, being nimble. The background with that is when I was a kid, my parents rented Indiana Jones. This was on, I think it was Betamax, actually, not even VHS. And I was supposed to be in bed, but I snuck out and watched from behind the couch as Indy, sneaks into the temple, feels the golden idol, boulders chasing him, arrows are flying, the locals are throwing spears, and he runs, dives in the water, climbs into seaplane, and takes off. And I just thought that was so boss. And when I was trying to think of what the name the firm, I thought, okay, gonna be small. I'm gonna keep it that way. Should be nimble, sense of adventure, fun, and that's what came to my head. Seaplane it was.
I love that story, and that's hilarious. You said something that struck me, which was that the early stage was the kind of the earliest stage where you feel like you could apply your skill set. To someone who, invests in more mature businesses, what does that mean? Like, is that like, how do you know if you're the kind of person who's like angel versus early stage versus, I'm a much more Series B investor. Like, how do those skill sets differ?
Yeah, there's a lot of nuance to it. I find that pre-seed seed, particularly like when I say pre-seed, pre-seed's a big, big tent. You've got everything from, idea stage, founding check, pre-product to post-product, fair bit of revenue. And pre-seed and seed, the labels can get muddied together. But for me, it's live product, early traction, early indications of a business. Like you can see what the business model is now, what it could be in the future. And that's where the public background is helpful
Yeah.
with. And then particularly the public background where, you have to have pretty sharp tools around things like unit economics, for example, and applying a lot of that in early stage and thinking about how those things could evolve over time. And I think when I looked at the scope of venture, by far the most interesting part is that pre-seed seed, and particularly, post product. And for me, it's this sweet spot of you have this massive asymmetry, if you're right, where typical valuation for company will invest in post money will be anything from 7 to 15 million. So these are pretty small. They're not companies anybody would have heard of. Nobody watching would have heard of any of our companies because it's too early. But the asymmetry for being right is enormous. Whereas if you wait and venture to invest in a household name company, let's call that like Series B, C, that could be cool and might be good bragging rights. You tell people at the barbecue that you're investing in something, but at that point, it's already $1 billion valuation, and you're paying 50 to 75 times the valuation that someone would have done at pre-seed seed. So if you think that your skill set is picking qualitative, understanding business models really well and conceptualizing how those things can scale, which I feel like is my strength, then I ought to go as early as I can where I can do those things, but no earlier. And that's where I ended up parking.
And I'm curious about the skill sets that are required to be good at what you're doing. So the first question is, what about your public equity experience do you think is helpful day to day in what you're doing?
I think public equities are the most competitive pool of capital markets in the world. It's everyone's working on the same information. And if you're trying to outperform over a period of many years, it's incredibly difficult. Persistence is very low for outperformance. And to do it, you really need an edge around execution, strategy, durability of your capital base. And those are really what I would say drives most alpha for long-term outperformers, public equities. So what I got out of being in the, knife fight of public equities is just having a respect for that and having to be really solid and having, look, we need to have a really thoughtful strategy that suits our skill set, temperament, it's differentiated, that we think we can execute, then go out and execute it really well and faithfully, stick with it, and then find a capital base that's really aligned with that. So just bringing that mentality into a market and game where most people don't think along those lines. Venture is competitive, but it still has more of a country club vibe to it than public markets by far, which are incredibly competitive. So I think having that as, a backstop was pretty helpful. I think having seen how a lot of these movies play out in public markets is also helpful. It helps to better, think about where things could be in the future.
Sure.
Yeah. And something that a lot of early stage founders, particularly technical ones like with me, I just had a conversation yesterday with one who was like, look, I'm really a product guy. I don't really get finance. And it seems like you really do. And that could be really helpful to me. Great. Well, I am handy with a spreadsheet and financial statement. So yes, I can help with that too.
And when I think about early stage venture, I think of underwriting people as much as underwriting product, business plan, all that stuff. So, what new skills, even maybe in your time in Australia, what new skills have you had to learn regarding the underwriting of people that maybe is not as prevalent in the mid and large world that you came from?
Yeah, I try to keep it as objective as possible, and I try not to base it off vibes. So whether or not I have a good rapport with someone doesn't mean much in terms of whether or not this person might be a good founder. In fact, them being difficult might actually be a sign that they're doing something different and thinking differently and more likely to drive a, outsized return. So for me, I try and focus on empirically what's associated with outperformance with founders. So one thing that is a signal that's consistent is industry experience. Doesn't necessarily mean that you, have an elite pedigree and an elite CV, but you understand the pain points that you're trying to solve for your customers. So that's something that I look for is just having a deep understanding of your customer base and the pain point you're trying to solve. Past that, a reality check on resources and how they can do the best with what they have. A really interesting study that was done on founders dug into kind of two different points of view. And this is a broad stereotype, but it was interesting. One was founders who look at a market and say, okay, we want to have markets this big. We want to have 1% of it. To have 1% of it, we need X number of salespeople, which means we need X amount of capital to hire those people. And they work backwards from what they want to achieve. What they found was that startups that took the opposite view had much better performance. And they were ones where the founders looked at what they had, the resources available to them, and said,
Mm.
okay, how can we make the most of our relationship skills, like the small amount of capital we have? Like, let's dive in and try and be as resourceful as possible. And those types of founders tended to outperform. So, if I had a perfect Venn diagram, it'd be someone with tons of industry experience who's very resourceful and scrappy. Um, some of the more classic, signals of like, oh, they worked at a Google or, they're a repeat founder. Some of those can be really strong signals, particularly if you're a repeat founder and your first startup was a success. That's a strong signal. But some of the other signals, aren't as associated with strong returns as you'd think. So if you're a repeat founder, but your first startup wasn't a big success, there's really no correlation with whether or not successive ones will be a big win. And I just really, past all that, just try to focus on what they've actually built. So not judge so much what their resume is, but have they built something early that their customers really enjoy? It adds a lot of value and they understand the customer pain point really well. And if they do that, then that speaks much more to me than wherever they might have worked before.
And when we're thinking about the timing of your launch, 2022 was obviously a tough time for the venture world, and it seems like maybe they're still trying to recover from some of the body blows it took then. I'm curious if the timing of your launch had anything to do with maybe an opportunity set you saw as a result of, the fallout from what happened in 22.
Look, there was definitely some opportunities with the timing. I felt like venture was going to go through a really big reset and felt that if I was going to set up a firm, which I wanted to do, then I might as well dive headlong in and make it happen because If you look back over time, when are great firms and track records built? It's during industry resets, really tough times. So it certainly had me, put my foot on the gas. And looking back on it, it turned out to be one of the worst windows for fundraising in a generation for emerging managers. Like I couldn't have picked a harder time to raise money. Um, but just like in most markets, the best time to be deploying is when it's the hardest to be getting capital to deploy. So I found it to be, I think, pretty attractive couple years to be putting money to work. And for sense of scope, the amount of capital going into seed and Series A deals over the last 3 years has dropped by over half. So there's much less competition. Deals close more slowly. Founders are much more patient on working with you to better tell their story. You can relationship build more. And when you write small collaborative checks, which is what we do, there's more room to get into those kind of deals and network. So I think in the long run, I'll be happy to have launched into such a tough market. In the short run, wouldn't mind raising more money like any other manager. But I'm optimistic about the timing and what it'll mean long term.
I appreciate all that background. I think it's a good time to dive into the strategy. I'm curious about where you see Seaplane playing in the early stage venture ecosystem. Like what is your role and how do you and maybe how does that and what kind of companies do you think you can play a big role in being helpful in?
Sure. So to go back, looking pre-seed, seed, live product, early traction. These are situations where they don't have enough traction to be getting the attention of an A16Z or Sequoia. They're not that big yet, but they still need growth capital. They want some attention. They want someone with a different point of view and bringing something more than just a check. So they're looking for hands-on help from VCs. And one of our points of differentiation with the strategy, both from pitching to the founder, but also from an investment strategy perspective, is we're pretty concentrated by venture standards. So only going to make around 15 investments over the life of the fund, which is less than half what the median is for small venture funds. It's not that I'm a glutton for punishment. It does a few things. It allows me to be more focused with time and capital. So I can write bigger checks where we do invest. I can spend more time supporting the founders where we do invest, which to me is a big part of the reason why I got into this in the first place. It's just more fun and interesting to be early and to be able to help influence and contribute to what these founders are building. I definitely don't want to take any shine or aura off the people actually doing all the work. But there's room to make more of an influence than from a public market role. And founders love that seaplanes concentrated. And when we invest, it is a meaningful check for us. There are a lot of venture firms where they invest and they write so many checks that, you know, the founder's happy to take the capital, I guess, but they know that they're not going to get much attention from their investors. And something that they really like hearing from me is like, okay, you're talking to the investment committee. The committee's all here. I'm a solo GP. I am personally 100% accountable for all performance. I have a ton of my own capital in the fund and we're concentrated. So, every check we write matters. And so you've got multiple layers of alignment and commitment from me to do what I can to help. From a founder perspective, they're pretty attracted to that. From a market perspective, the way these deals tend to come together in venture is you'll have a syndicate lead. So someone who will write a check that's typically half the round size. And then you might have 10 other small investors who come in. Typically what they're looking for, what the lead and the founder are looking for is not just the additional capital, but different skill sets and perspectives to help out with those founders. So, some VCs are really good at go to market, for example, or they're really good at PR. My strength would be unit economics strategy around that. And I specialize in startups that have business models geared around network effects or recurring revenue models, which is where I have a lot of domain expertise from having invested in for a long time. So I can get pretty nerdy and wonky with founders on those topics, build tools for them to help them better understand their unit economics, how hard they could be pushing. Yeah, and that's where I focus, I enjoy, and it seems like the founders like having me along too.
We talk a lot about concentration on this podcast, so I want to double click there a little bit.
The common stereotype of venture capital is that you win by investing in dozens or even hundreds of companies with the hope that one or two will return the entire fund. That is not your strategy. You're limiting yourself to 15 investments. I'm just curious on how you settled on that as being a number that's both doable for you as a kind of one man GP, but also gets you some level of diversification, given that, the base rate here is that these businesses are not going to turn into the next Google or Facebook or Uber or something like that.
Yeah, I think the mantra and venture of spreading your bets as widely as possible to boost your odds of catching a unicorn, it's really overdone and one-sided. So while it's true that if I wrote more checks, it would increase the odds of my catching one, I'd also be diluting that winner down much more. So I need to catch one if I write 100 checks because I've diluted myself so badly.
Mm.
The other thing that you don't hear come up often, but is very practical reality, is that if you write more checks or looking at the same amount of deal flow, you are lowering your standards. Like that's just literally what it means. If I wrote twice as many checks looking at the same number of deals, I would be writing checks into companies where I don't have as much conviction as I otherwise would. Do I intuitively think that's going to help with performance? Probably not. It would probably also mean I'd have less time on diligence. And there are studies that show that investors who spend more time on diligence have better performance than those who don't, which is intuitive. And we could get into a conversation about how much time to spend on diligence. That's its own thing to dig into. But another factor to get back to working with founders is there's also research that shows that investors who are more hands on with founders have better performance than those who are hands off. So for me, like, well, I want to be more hands on. I want to set a high bar. And those are intuitive to me. They seem to be backed up by data. And I think it's for me an optimal strategy. And I totally acknowledge there are a lot of different ways to do well in venture, and different people can do well with different strategies. So if you're someone who has a mega brand, like if you take a Jason Calacanis, for example, Jason sees so many deals and he can get referred into so many deals and still have a really high level of quality for what he sees. It might make more sense for Jason to write a ton of checks. And his LPs are essentially indexing Jason's brand and relationships. And there are probably some LPs who would find that attractive. And you could say that probably makes a lot of sense. And on top of his skills, it does really well. But for someone whose skill set and background revolves around being a picker, which is where most of my alpha came from in a public sense, it just makes sense to do exactly that and be focused.
If I were an LP and I was looking at your strategy and investing with you, I'd have to get really comfortable that you're going to have a higher hit rate than maybe someone else with a different strategy that's a lot more diversified. So from a process perspective, like what do you do if you're only going to make 15 investments? What do you do to try to improve that hit rate?
That's a great question. So one is cultivating relationships with other investors who have similar tastes, um, just as far as top of funnel. And that's maybe its own thing that we could dive into would be like how ideas come into the funnel to begin with. But something I'm very big on that I picked up from my public market days from back when I was an analyst and I pitch ideas and they get shot down from the PM. You learn about how to be efficient with your time. And so my process, even though I don't have institutional LPs, I'd call it institutional grade behind the scenes. And it's very much oriented around efficiency, velocity of idea gen, and scaling up the amount of diligence I'm doing when opportunities come up, but not wasting time on ones where I just don't think there's going to be a potential fit. So to give you some specifics, like I'm a big checklister and I have different scales of checklists that I use for when I work through an idea initially. So I have like an initial pass of a checklist that has different qualities that I might look for. I'll kind of go through it, see if directionally it's interesting, worth more time. If so, spend more time with the founder. I use expert networks to round out the knowledge and skill set as well. Again, helps me get up to speed faster. And when you are small, your superpower is speed. It's agility. It's being nimble. Like if I compare that to bigger shops, I don't have a set ownership target for when I do a deal. I just want to invest in the best startups possible and help them along the way. So when we invest, we have the flexibility of, well, we can come into a round where there's a really strong syndicate lead and we're part of a bigger round, and that's okay. Like there's no ego with that. We don't need to lead. That's fine. But we've also been in situations where our two most recent deals actually were ones where the founders had great traction. I loved the business model, thought the founders were outstanding. They weren't quite ready to go out and raise a seed round. They needed a little more capital to get them to place to do that. I had conviction that they would be able to raise a really solid round. So I invested going it alone, essentially writing a check between rounds. And those worked out really nicely with founders raising on the other side of that. And that's the kind of thing you can do when you're small and nimble, but you can't do if you have a big ship. So, one of the perks of being small is that flexibility to take advantage of different situations.
You mentioned sourcing and idea generation. I think this is a good time to talk about that. Love to hear about where ideas come from, and how I think one of the concerns I would have if I were in your seat is some level of adverse selection, which is that somehow like I'm a one man GP and I'm, like I've got a good network, but it's never, we can't compare to what Sequoia's got. And so if, am I going to be seeing the best deals, or am I fishing in a pond that's inherently less quality? So love to hear your thoughts on how you navigate that stuff.
Yeah. Adverse selection is definitely real. And I think it would be naive to pretend like it's not. But at the same time, I'm not trying to play the same game as some other firms and funds. Like I'm not trying to out Sequoia. They've got resources that I'll never have, never match, and network size that I'll never match. But they also tend to pay a lot more than I do on valuation. They tend to compete on deals that most other people are already fighting over. And I'm not saying I'm trying to do value investing in venture, but I'm not necessarily trying to invest in the absolute hottest deals possible either. There are people building great startups all over America, not just in Silicon Valley. So if you're looking at different places, you'll find that growth rates can be similar, still really attractive, but valuations and expectations be much more reasonable. So that'd be one facet. But to go back to deal flow and sourcing, top of funnel for me, the two main contributors are referrals and direct inbound. So referrals, because of the strategy where I'm writing these collaborative checks, like roughly a quarter million, which at venture land, it's enough to get you a seat at the table at pre-seed and seed, but it's not so big that if a Sequoia was in the round, I wouldn't necessarily get boxed out of the round because they're still going to get their allocation size. They'll get to their target, but it's a check size that will get me in the door. So that's really helpful. And as a result, I've got a lot of other investors who are interested in working with me on sharing deals. So that's a two-way street where if I see something that's really interesting, I share that on and vice versa. So that's an important part of deal flow. And um, guess you'd say top of funnel and sourcing. The other part, direct inbound, very deliberately trying to build a brand with founders. So I've got my own podcast. It's called Investing in Startups. It's exactly what it sounds like. And it's got an audience of some VCs, some LPs, and some founders. And I've had founders approach me, like, hey, I really like your show. I love what you're talking about. It'd be really fun to have you involved. Both of those are fairly proprietary, depending on how you define the referral piece. And where over time I'm going to get most of my deals. I don't focus almost any time on outbound. In venture at pre-seed and seed, if you're a small shop, it's just a horrendous return on invested time. Um, the reality is that it's very asymmetric. You don't know behind the scenes what's happening with most startups. And because, we look at more than 100 deals, it's a royal we because it's just me and the dog. Um, we look at more than 100 deals for every one we do. Well, if you're trying to do outbound that way, that's terribly inefficient. And that can work if you're a Sequoia A16Z and you have a river of, management fees to pay for associates to go out and cover the waterfront. But if you're trying to be pragmatic about your time, referrals and direct inbound are by far best sources.
How does Twitter help with all of that?
So Twitter's helpful. I've one of our biggest investment in the fund, both on cost and value, was one that was sourced through a Twitter relationship. I met another VC who came across a founder who was interested in, anyway, long story, but that's turned out to be our best investment thus far. Happened through Twitter, slash X, whatever. It was Twitter at the time, but that was really helpful for me. I mean, to be honest, I actually get more engagement off LinkedIn than I do on Twitter slash X these days. And I'm not a power tweeter. I just don't have that much to say. I know that may sound funny, but I just have a very consistent philosophy and I'm not very newsy. Like I'm very focused on strategy and my strategy doesn't change very much. And so I'm not someone who's out there like sharing photos of what I ate that day or what my cat's doing or anything along those lines. I just try and keep it all business. So it tends to lend itself to other platforms. But yeah, but it's been helpful. And when I do use it, it's trying to just make sure that people on there know what it is we're after and how we invest. So if they want to find us, they can.
And my life has changed as I've moved into the private markets where I'm in a similar situation as you are, as we're seeing a lot of deals and we're passing on almost everything. But but you want to give each deal some level of time to understand whether it's worth spending more time on. I'm just curious given the number of deals you're seeing and the number of deals out of 100 that you invest in, how do you what processes are you using? What tools are you using? What are you using to help you get through that many deals without spending all your time on things that are never going to turn into anything?
So I'll walk you through when I look at a deck for the first time, maybe how I scan through it. And the reality is that's probably 2, 3 minutes. It's fairly quick, which founders don't really love hearing, but there are so many of them. That's just kind of what it comes down to. A quick first pass of the deck. And this is assuming I don't have a warm intro from someone who knows the founder and I don't have more context. I'm trying to quickly understand what is the problem they're trying to solve? Is it real? Is it large? Is it painful? And is the market around that growing? Is it attractive and growing? Does the solution they have actually solve that problem in a big way? Like it really adds a lot of value or joy for the customer. Do I think that those customers will be very loyal as a result? And might there be, and that's kind of on the subscription side. On the network side, do I think there could be network effects here? Is there some kind of self-reinforcing dynamic to this business model where if you catch lightning in a bottle, it becomes a thunderstorm? And those are the things that I'm looking for initially. Look at founder background, like, okay, do they have relevant experience? Do they have some clue of what it is they're talking about? And that's just like first pass and then traction. Have they actually got someone who's paying for this product? Who is it? Have they done something more than sell to their old college roommate? Like, have they made some progress and proven that they've got something valuable enough that even though they might be a technical founder who's not a natural salesperson, they've been able to convince some people to buy it. And so if all those things kind of vaguely take shape looking at a deck on a first pass, I'll take a meeting for that. And then, we'll go off and try and learn a lot more about the product from there. But that's a first pass. I will say I am trying to automate myself and get more scalable. So I've built a custom GPT where I feed it a deck and I've trained the GPT on all my internal research, letters, memos. I've done a lot of Q&A with it to coach it and I can feed it a deck and it's pretty accurate on guessing whether or not I'd like to have a meeting off just looking at the deck. So that's the kind of thing that as Seaplane scales, I'll probably be introducing more AI tools around it. And that's just a practical use case of AI in action, not like, not sizzle, but steak and trying to use more of that to help me scale.
I get the sense that you're a relatively patient investor, and you're not looking to just deploy as much capital as possible so that you can raise the next fund. For someone who doesn't spend a lot of time in venture, I'm curious how long funds typically take to deploy the capital they raise and how Seaplane may be different on that measure.
Yeah, you read that correctly. So a mature venture firm doing, let's call it Series A and beyond, or a few funds in, they'll typically deploy over 4 years, and that can slide up or down depending on the market. But that's a typical window, and that's what we're doing in Seaplane. Most small funds, though, around the size that ours is, will deploy twice as fast. And during the boom, you had some funds, like I knew some folks who write in check a week and they deployed in 12 to 18 months and they fired all their ammo and they're probably not going to get another round of ammo, I would guess. Um, but yeah, I think coming in, the market probably would have given me leeway to put it all to work in 2 years because that's what a lot of small funds do. But, this is by capital in the fund. And the big goal here is long term outperformance. So we want to be patient with that. And if it takes twice as long to deploy it, so be it. So in in the medium term, would I be better off, marginally with a little more management fees? Sure. But I don't think you get into venture running a boutique for the management fees. You're doing it for performance. So the strategy and deployment window, it's all aligned around trying to boost the odds of being able to deliver winning long-term returns.
I'm a value investor at heart, and that translates from the public to the private markets. Nothing really changes there for me personally. I'm curious, as you're thinking about valuation in a world where these businesses are very early stage, you're paying revenue multiples and, there's not
Assuming there's
clear
revenue.
benchmarks. There's not clear benchmarks necessarily. There's no public comps may not be relevant at all. Like, how do you think about and try to avoid overpaying, in these situations?
So high level, I'm price sensitive, and it's because I don't have to sell value guy on this, but the price you pay does ultimately impact your total return, right? And you'll hear venture guys say things like, "Oh, well, if you invested in Airbnb, it didn't matter if you were in at 6 million post or 60, you still did incredibly well." While that is true for the winners, that also means that if you invest at 60 million posts instead of six, that your return will be a tenth what it was otherwise. And to me, the whole point of being early pre-seed seed is just to have that massive asymmetry when you're right. So I do feel it's important to not get carried away on valuation. No, I'm not sitting here doing like a reverse DCF to figure out a fair price. Now, I do my own forecasts and models, not to the same degree that, if someone on the sell side were to look at my models for these early stage companies, they'd laugh. But it's just a totally different beast. And what I'm trying to directionally understand is what are some scenarios where I think this could turn into a massive winner? And if I can't articulate that after I've already learned everything qualitatively about the business market model, et cetera, then I don't want to overpay for something around that. And I've had situations where I like the founder, I like the team, um, but it may be something as direct as and sometimes we market size that constrains that. So the product itself might have great unit economics. You might have some network effect, might be very sticky, solves a great pain point for customers. But the market is so small. I'm like, look, I just don't see a scenario where you're going to be able to grow into a valuation where I can get a 50x return on this investment. And so this is a pass for me, even though your valuation superficially may not be all that high. So, that's an example one where we might pass on price. Um, Another would be, even though now this will sound a little loose, but it's directionally helpful. I do look at market benchmarks for pre-seed seed and just try and triangulate around. Like if I'm looking at a deal where I think this is a superior founder with great early traction, with a product that customers seem to love, in a market where there's room for them to run, and the valuation is around market or below, cool. I'm fine with that. And I won't get too fussy about the price at that point.
You mentioned before that you focus on areas where you have a domain expertise. I'm curious if that's more about business model, like recurring revenue and network effects businesses, or whether that also leads you to certain types of industries where you have experience.
Yeah, it starts with the model. I think most VCs, rightfully so, start with the premise of what's the lens that I'm going to approach things. Most of them do it through industry, which is understandable because they might have domain expertise from having been an operator in an industry. For me, having invested in, different countries, companies of different sizes over many years, I eventually concluded that instead of focusing on industry, I should focus on the business models that I think are most associated with driving winning returns, long-term outperformance. And so for me, the two that were closest to my heart and I best understood were network effects and recurring revenue. And so that's how I tend to approach things through those lenses. Try to have pattern recognition with that. It helps with coaching founders. It helps me to see when there's traction sooner than someone who's an industry expert might necessarily see. Now, from there, I do need to round out my industry knowledge and market knowledge. And, sometimes it'll be a space that I don't know as well, but because I've been investing for a long time, I've invested in a lot of spaces, so that helps. But, if there are industries where I do invest more over time, there are some, yes. So, B2B software would be one where I spend a lot of time of like SMB up through enterprise. Payments would be another. Marketplaces, e-commerce would be others, um, a little bit of supply chain. So those are ones where I've got a little more familiarity, like when I dive in and start talking. Um, yeah, but it's model led from the start.
Yeah, interesting. We've talked a lot about the background of the founding of the firm and then touched on, the philosophy surrounding the strategy. I think this would be a good time to talk about an investment that you've made that you think fits in, one or both of the network effects and recurring revenue buckets.
Sure. Well, I'll go with the most recent one, which is Ruck, and it is a three-sided marketplace that is trying to build something akin to a DoorDash, but for construction. And not for like if you need some caulk delivered to a job site, but if you need 100 pieces of steel rebar delivered to a site in 2 hours, Ruck can handle that for you. The founder has tremendous Lee Chang, he's the lead founder, CEO, has tremendous founder market fit, grew up in a construction family, built a lot of the code himself. Fantastic hustler. Really enjoyed conversations with Lee. And what I really liked about the model was it's solving a clear pain point for the customer, the core customer being professional contractors, and doing it in a differentiated way. And in particular, the go to market was clever. So, what they realized was there are players in the industry who are merchants with things like flooring, timber, where you're dealing with something that they specialize in. That's what they sell all day, every day. They're not great at delivery. They're great at that one thing, but fulfillment is not great for them. They're slow at it. They need wide delivery windows. They don't love having trucks and crews handling all that because it's not core to them. So what Ruck figured out is, well, why don't we partner with these guys and they'll refer us on to their customers who then like what we're doing, use us for other jobs and refer us on to other merchants and have a viral go to market around that. It's early, but I like the traction they've proven out with it thus far. A little more about what makes it kind of seaplaning is this is one where they've proven out to me what looked really interesting, but they weren't quite ready to do a seed round. We went ahead and invested with confidence that they would be able to pull something together. And credit to them, very recently, they just announced an oversubscribed seed round that was really well supported with some great VCs that I'm thrilled to have as co investors in the company. So, it ticked a lot of boxes. You got great founder market fit, great industry expertise, great solution for customers, large market, room to run within that. Um, and I guess with the market too, you know, something that's interesting with venture that you don't see quite as much in public markets is when you talk to companies at pre-seed and seed, you have to invest more time in understanding competition, which I realize you do in public markets as well. But in private, it's more on you to figure that out. And usually because the competitors are also private. So it's harder to run down information. But in this case, I went and dug around and found that there was actually a very well funded startup coming out of Canada that had tried to do something very similar and completely imploded, despite having massive demand. And there were still reasons around the business model, which I won't weigh into here. But I came away from it having conviction that there was demand here, but the market hadn't had someone solve the problem well from the delivery fulfillment side. And I felt like Ruck would have a good chance at solving something like that. So that's it in a nutshell without, getting under the covers of any of their numbers or whatnot, which obviously I liked. But yeah, it's a, kind of classic deal for us.
And are they specifically matching those distributors of whatever lumber and rebar with outsourced outside delivery logistics partners? And that is that them? Is that how so that's okay, got it. So it's
Yeah.
at
So
them.
they've got
They're not trying to physically build a fleet to try to help these people.
yeah, they've got a network of dudes with big trucks. And those big dudes with big trucks, they get paid to go pick things up, move it, and the supply of that is actually much deeper than you'd think because it pays pretty well. And guys with these big, heavy assets are happy to make a little extra cash, using some free time they've got to move some stuff around.
Interesting. Well, that's a really good example. Thanks for sharing that. Uh you're kind of early in your venture career, so I don't know if you have an example of a mistake that you've made early on that you'd love to share, or from your public investment world, I'd just love to hear an example of a mistake that you made that forever changed the way that you invest.
Yeah, I'm reluctant on the venture side to name much. I could think of a couple, but they're probably a little too recent, and I don't really want to bring them up to kind of drag the founders into anything. But I do have plenty of bangers of mistakes from my public markets days. You do it long enough and you have a collection of them. I have a file called Joe's Mistakes, which has a long list. Probably the most impactful and, reflects a lot of what I do at Seaplane is Apple. So 2001 iPod, iTunes come out. I was super optimistic about that. Up to that point, I'd been using Napster just like everyone else. Well, I say everyone else, college students to get music. What I realized was that by creating something that was easy to use, letting people just download music to a device, 99 cents, it was just incredibly easy and taking the friction out of the experience and the potential like early network effects around it could just be huge because Napster, like LimeWire, those products back then, anybody use them, they were really a hassle to use and, you know, frowned upon. So having something like that come along felt like a huge opportunity to me. And at the time, Apple had a lot of cash still. I think, if we went back and looked to be very reasonable valuation, and it was around 25 cents in split adjusted terms from today. So had I bought, and I did buy it, but had I held it from that point to now, it'd be roughly 1,000x, over that time, which which would be pretty cool. Unfortunately, I sold it a month after I bought it. And now, little Grace, I was like 19 at the time, but I sold it because I'd read Buffettology book and I came away from it thinking, I want to be a serious investor. And serious investors don't invest in tech. Now, the real lesson there is not that serious investors don't invest in tech, but it's just to be your own investor and not try and parrot someone else's work and do what comes to you. And so, I think about that. I try not to think about that one too often, but yeah, it's one of many mistakes over the years, but probably the um, biggest omission.
Yeah. No, that would have been a good one. Even if you tell a little bit in PA, that would have been a good one.
Yeah.
I think the whole value community has, a number of luminaries who serve as mentors. I'm curious if there's anybody in the venture community that you think has a similar philosophy and, maybe you don't want to run a big firm, but in terms of the way they invest and the way they think about working with founders, like who comes to mind if I'm asking you like what kind of ventures investors who could serve as either actual mentors or kind of mentors from afar for you?
Bill Gurley, for sure. A longtime fan and reader of his work. Just tremendous thinker, particularly around network effects, but also someone with a public markets background and, approaches things a little more critically than I think some other venture investors do. Thinks a lot about unit economics, scalability around that. And so that always spoke to me. And I really enjoyed reading this stuff over the years. And I think the firm that he played a big role in upgrowing, Benchmark, is one that comes up a lot in conversations I have with LPs. So, not that I'm usually bringing up other firms, but I get a question along the lines of, what are you trying to build, Sequoia or Benchmark? And using those two extremes, as Sequoia being a supermarket or, with amazing performance over a very long time. So if anyone there is listening, I'm not trying to hurt anybody's feelings, but, a, a full stack venture firm that does everything versus a tiny boutique being Benchmark that does one thing, which is early stage, and they try to do that thing very well. And I'm very much in that camp of, no, look, I'm just trying to run a boutique, focus on elite performance. And so, I'd say following Bill's work over the years and following the work that Benchmark and them have done, yeah, definitely learned a lot from them.
And one of the things that I've started to focus on as I've moved in the private markets is these structures and silos that I believe create opportunities for outperformance. For example, I think that there's a big disconnect between lower middle market private equity investors and public company microcap investors who are investing in similar size companies but almost never talk to each other, interact, and never look into each other's markets. And so to me, I see a structural reason why somebody who runs a hybrid strategy and who can go across, do public and private, may have a chance to find better investments. Are there any are there any silos or structures or fundamental reasons why you think that where you're playing, um, just just tends to give, well, everything's probabilistic, but it's a higher probability of outperformance, or there are pockets to be able to exploit as a smaller firm with who's playing in that space.
Yeah, I mean, I think it won't surprise you, but like pretty much where I situated, which was, at this place where valuations are almost as low as you're going to find within a venture scope, but we are getting just a little bit of like a tickle of traction and indications of where things could go. I mean, if I were to kind of pick on another place on the venture spectrum that I don't find attractive, that might be illustrative. So, you mentioned earlier in conversation, like, how do I know I want to be here, like Series B? Like to me, Series B, CD, kind of that range, that to me is the least interesting space because at that point, it's very clear that a startup's already got product market fit. Like it doesn't take creativity to spot a winner at Series B. Like they already have tremendous traction. They've blown past, 10 million plus in revenue. Like it's pretty clear that there's a there there. The question really is how big could that ultimately be? And you'll have difference of opinion around that and whether you can win the deal because your firm has better brand recognition. So that to me, just from a creative standpoint, is not as interesting as being earlier. The other thing is from a return standpoint, you are paying a vastly higher valuation and price. You might be coming in at $1 billion or a few hundred million up to, $1 billion valuation where things really need to work out in a very big way for you to get an outsized return, but you're still dealing with all the illiquidity that comes with being private.
Yeah,
And
and
so
the
to
risk.
me, I'm like, yeah, I'm like, this feels like kind of the worst of both worlds where like I'm getting all the illiquidity of private, but I'm not getting like the home run potential of being really early. So to me, that's a space that I don't find very interesting. I feel like I'd almost rather be back doing like a micro cap or, small cap growth where at least you have public liquidity. Now, granted, moving some of those positions, as anyone who's ever tried to move a lot of a small company that's public would know, is easier said than done. But I'll tell you, it's a hell of a lot easier than if you're invested in a private company.
Sure.
Um, yeah. So I still like, and I think people can do really well with public small caps for sure. I guess for me, just with my focus, I feel like I just want to be all in with the zone that I'm in and building relationships and deal flow around that and the network effects that hopefully will come with it over time.
You're a couple years into this journey. If we're having this conversation again in 7 years, how would you define success at Seaplane?
Performance, the winning performance for LPs. We may not have a lot of distributions at that point. A funny thing with early stage venture, is your biggest wins are the ones that take the longest to become liquid typically.
Sure.
So, having some wins that are from good process and judgment rather than, you know, bad process, good outcome, where I could go back and point to, look, this was the thinking at the time. This is all our internal work and it played out like we thought. And if we had some of those that play out in a big way, then that would be really validating for the founders we support and for our investors. Yeah. I mean, that's ultimately why I'm doing this. I'm a very competitive person. I enjoy working with founders. I like being a teammate. And even though I work by myself, I still like to work with these guys where I can and ultimately try and deliver for the LPs that I've got, and I focus on like high net worths and individuals rather than institutions from an LP base, which is kind of counter to most people in the industry, but it's largely because I like working with individuals. It's more rewarding for me to move the needle for individual people and their goals than, very large institutions where it's hard to move the needle if you're 1% of their capital.
If we're judging the returns of a 15 investment fund, and we can see, and I'm an LP, and I'm trying to figure out whether I want to invest in your next fund. Is 15 a big enough sample size to really know if Joe's a good investor in this space? That's
That's a
that's
fair question.
that's the concern I have for you, is that you could be an
Yeah.
incredible investor, and just 15 swings is not enough in this world to prove that you're an excellent investor.
It's a fair question. And one thing I ran into over my career is I moved mandates multiple times and each time it went really well. Um, but I would get that question over and over again. And I guess from a public side, eventually people came around and like, nah, I think he's just good at this. But here, I'm having to prove it all over again, and that's fine, and I should, just like anyone else. It's a good question. I think you need to go back to kind of what I touched on of aligning what was the thesis and how how did conviction line up relative to what played out and your thesis at the time. So, yeah, I think if I was writing 50 to 100 checks and I had one be a unicorn, ironically, to your point, someone who might look at someone who wrote more checks and caught a unicorn, they'd be like, well, this was the process. They made more investments. It's more representative. And while like statistically true, you're also like, yeah, but of course, they're more likely to snag a big winner. Um, yeah, I think you really need to just focus on also finding LPs that kind of think like you do. And if they're the kind of people who focus on good process driving good outcomes, then that's the type you're looking for. One thing I've learned talking to investors over time is that, I'm a concentrated investor and really always have been. There's a type of investor or LP or allocator who that speaks to. And that's probably 20% of them, maybe. And the most don't want that. They don't want it. They don't want concentrated, and that's fine. So I try to focus on just finding LPs who kind of share that worldview and think about, no, look, I totally get it. Like, want to set a high bar and more wood behind fewer arrows. Like, that speaks to me too. So when I talk to LPs, it's finding those who kind of share that Um, but yeah, no, it's an interesting question. And it's entirely possible that, I could have fund one, fund two that both turn out to be big successes, but it could be like 10, 15 years before people give a lot of credit for it. But I'm playing the long game with that and kind of going eyes wide in that can happen.
Well, Joe, this has been a really good overview of your journey and then how you're implementing your strategy and using the public markets expertise that you developed to inform your strategy. We'll close with the question we ask all of our investment manager guests. What do you think is the most underappreciated aspect of the investment opportunity in front of Seaplane today?
Well, I think that the asymmetry at being very early is just so large, and that there's a window of time here where emerging managers have just been gutted for a couple of years. And it feels to me like there's a period where people who dive in, do really good work, could drive some really good returns and build some big firms around that, or at least track records that they're really proud of and the size firm that they want to build. Um, And I think that the opportunity set is only going to continue to grow. It's getting easier and easier for people to create new companies. And a lot of the new generative AI tools that are out now allow non-technical people, including people like me, to build products that, can go out and be monetized. And so the amount of capital that goes into these companies is falling. So I think it makes it all the more reason to be early, where you can write checks to help fund them when they may not need as much capital as they would have before to build the company. And so all that has me really optimistic about the business, where I'm at long term, the scope of innovation that's happening in America. And yeah, I'll say whatever your politics, I do think that there is a lot to be excited about from the incoming administration around being more venture friendly, being more little tech friendly, startup friendly. And again, whatever your political views, it's hard to disagree with that, I feel like. So all that has me, pretty optimistic about the future.
Well, it may be 10 or 15 years before anyone appreciates it because of the long gestation period, but I'll be really curious to see how this all plays out. As someone myself who's moved from the public markets to the private markets and is learning all kinds of new motions and new ways of being, this is very insightful. So thanks so much for being on Compounders.
And thanks. And I look forward to being back on in 15 years to talk about how it all went.
Hopefully the podcast is still around. We'll talk then.